Today we're going to be talking about cash. If you say you've run out of cash, that's pretty serious, and it's equally serious for a business. Measuring and reporting cash flows is going to be our primary focus. First of all, here are the learning outcomes. You can look at those at your leisure. First of all, how do we define cash? And for a business, it's not quite the same as you would define it, though perhaps not too dissimilar. Yes, cash is cash in the till that the company will have, but it's also cash at bank, which you would probably also count as cash. We would also include cash in a deposit account, cash that can be taken out at short term. With short notice, so it might be, as I say, a deposit account or other account which can be turned into cash quickly, or it might be an investment in treasury bills which can be sold within a couple of days. This is termed liquidity. Cash is in varying degrees of liquidity, with the treasury bill being the less liquid and cash in the till being the most liquid. This just asks the questions: are the investments short-term, such as a treasury bill? Are they readily convertible into cash? Yes. Is there an insignificant risk of changes in value? Well, sort of. That perhaps not quite as essential as the other two. The really essential one is this: is it readily convertible into cash? Never mind what it is. If it can be turned into cash, then it's very quickly. Then it's cash. This is the role of the statement about cash, which is a statement of cash flows. We have the owner's claim, the statement of financial position, at the start and the end of a period. The income statement, we know, measures the change in the owner's claim, a profit being an increase in the owner's claim on the business. The profit is owed to the owner, and the statement of cash flows is a record that accounts for the changes in cash holdings of a business. If we look at the process in a slightly more dynamic manner, we have the profit and loss account that we were, or income statement, that's that one, and the balance sheet, which is our statement of financial position. What happens during the year is that sales turn themselves into debtors or cash. In business, a lot of sales to businesses are you get an invoice, and the invoice is paid within 30 days. So that's cash coming in from the selling activities. Then the business has to try to turn the debtors into cash. So the blue and the green represent kind of inflows of cash into the business. Note that it's perfectly possible for a company to report a profit, but actually to have cash flow problems. Profit is not the same as cash, because it turns itself, or can turn itself, initially into debtors. Then there's the other side of it, the payment side, starting here really with the purchases, the cost of sales, which is again not necessarily paid for in cash. So you have a creditor, someone who you owe money to, who has to be paid in 30 days. So a creditor is created. Creditors need to be paid, not immediately, but paid out of cash or out of overdraft. And that is basically the cash cycle of a business, the main cash cycle of a business. There's a standard presentation of these accounts. You don't have to invent the format. It's perhaps rather stricter format than the profit and loss account. Well, they're more or less pretty strictly controlled these days. Cash flow from operating activities, then cash flow from other investment type activities, savings, etc., and then cash flow from borrowing activities. altogether account for the net increase or decrease in cash over the period. So this just sort of looks at the three activities and makes the point that they are all part of the movement in cash and cash balances. Here's a summary of Tesco's cash flow statement, and we'll have a quick closer look at this. So we start with cash flows from operating activities, starting out with the operating profit of continuing operations. Now, as we've been saying, not all profit is cash. Sometimes it's debtors and payments, deductions that are not necessarily cash payments. And one of them is depreciation. So that's a deduction from the profit and loss account that isn't actually a cash outflow. It's kind of a reserve out of, making sure the shareholders don't call it profit. So it's not an actual cash payment, so we have to add that back in because it's a deduction that isn't a cash flow. For certain items such as these pension adjustments, you'd have to read the notes to see what that is about. Here's a small Tesco non-cash items included in operating profit, so that has to be again added back in. Here are the working capital items that don't make a lot of sense initially, so we'll just have a brief explanation. Decrease in inventories. Part of the profit is the cost of sales and the gross profit. Part of that gross profit, as we've seen in an earlier lecture, is charging out goods from stock. So if there has been a net decrease in stock, or inventories as they call it these days, if there's been a decrease in that, then that's not an actual cash expenditure because it's come out of stock. It's not been made in the period. So there's been a net decrease in stock that's gone out as a cost. It's not a cash flow, so it has to be added back in. Decrease in trade and other receivables means that there's been a net payment from debtors over the period, and that's a cash inflow. Similarly, for the decrease in trade and other receivables, a decrease in debtors is positive. Now we have an increase in trade and other payables, that's creditors. So the increase is positive, so if creditors are kind of lending you money to buy goods, that's like a cash inflow, so that's positive. Then we have some bank items which would not normally be for a business included. We generally don't talk about banks because they're slightly different. It can do, but it can get a little bit confusing. So all this in the box has been totted up, and there's a net increase in working capital. Right? So that's a net increase in debtor type assets, and so that's a use of assets. Adding all that up gives us cash generated from operations, and then some interest paid and money received gives us a net cash generated from operating activities. So quite a lot of detail goes into the cash flow statement. Then net cash used in investing activities, we won't go into that here, but clearly they've been using up some cash in investment. Net cash from financing activities, and that's cash used from financing activities, whether that's repayment of creditors, net repayment, or what we'd have to have a look at some of these notes. Repayment of borrowings, that's obviously a use of cash. And increase in borrowings is a source of cash, just as increase in creditors was. Whoops. Sorry about that, small case of fat finger. Cash and cash equivalents held in disposal groups at the end of the year. Right, so that's just like saying cash on the balance sheet. And it takes the beginning of the year, it takes the what is it? It's the net cash from generated from operating activities, the +2 there, less the net cash used in investing activities, less net cash used from financing activities. So it's following our format pretty strictly. Gives us a net value of 907 plus the cash balance at the beginning of the year, a minor adjustment, and then cash and cash at the end of the year. So it's the kind of like the movements on the cash plus the opening balance gives us the closing balance. Here's a summary. They're not the same figures. It's not the same year, I don't think. 2015, I think it was 2016. But it's the same idea. Cash generated from operations. It is on the previous slide. It's 2015 is the previous year here. So the bottom figure here, net decrease in cash and cash equivalents of -717 there, is the 717 figure here. So we have it all laid out, and you can see how these how these headings explain the change in the cash position. Two approaches that can be taken: the direct method, and that is looking at the actual cash account, if you like, and the cash outflows and inflows, which is kind of what a small business would do. And the indirect method, we've been looking at the indirect method, which is a little bit disappointing because it's really taking figures that you can see from the balance sheet anyway. So in what the question is, how is this increasing the information provided by the accounts if you can make it up from the balance sheet and the profit and loss account? The answer is it isn't adding to our information set. So on that basis, one might say that these statements aren't very useful. And I did a quick check in the academic journals to see how many people had written about cash flow statements. Almost no one has written about cash, because there's not much to say about it from an information point of view, because all the data is in the other statements. So it's largely a presentation job. It was added because I would guess because academics were kept on going on about cash flow and the importance of discounting cash flows in valuing projects, and the share is investing in a share as a project. So you want to know about the cash flows. But to a businessman, cash flow is extremely important, because if it breaks down, then the business breaks down. But if it's going more or less, then it's okay. So it's like a switch. It's an on-off kind of variable, and you can sort of get into cash flow problems. So there's some gradation, but for most businesses, almost all businesses, they're not going to have great cash flow problems. However, that's wandering away from our task today, which is to look at cash flow statements, and here we have a formalization of what we were talking about when looking at the Tesco accounts. We add back those expenses that weren't actually cash flows, and then we have our plus or minus, an increase we deduct, and a decrease we add for stock. And then for debtors, that's the same. These are assets. A decrease in an asset is a source of finance. An increase in an asset is like an investment. You must have paid to increase the asset if it's stock. And then it's the opposite way round for payables, which is creditors. So an increase in creditors is deducted. No, it isn't. It's added. So increase in creditors, as we were saying with the Tesco statement, is like a source of funds, source of cash. And a decrease in creditors, well, we must have paid them, so that's a deduction. Right, then we have these other items of actual cash flows, and that gives us our net cash flows from operating activities that we add to the opening balance, and hopefully those two figures will add up to the closing balance, much as we looked at when looking at the Tesco accounts. Operating cash flow, it doesn't, well, his BP, you look at that and you think, oh, BP must be doing well. Well, it doesn't necessarily mean it's doing well, because positive cash flow isn't necessarily the same as sales, because you may be making more sales but increasing your debtors. Similarly, and so we've got an increase in cash flows here, it could just mean that it's reducing its debtors, and that sales aren't necessarily increasing, certainly at the same rate, if they are increasing. And it could mean that it's just borrowing more, and therefore improving its cash flow by not paying its creditors. And cash flow is not the same as profit. So cash flow is very important to keep a business going. If the creditors are not paid, the business can be wound up and it's game over. On the other hand, it's not telling us a great deal about the profitability of the company, the financial health of the company, the risk of the company. And these are vital things in valuing a company. It's not saying a great deal about those features. So you must be very careful when looking at cash flows not to go thinking, oh, this firm is on the verge of bankruptcy because it's got cash flow problems. Well, it might be a building firm, and building firms operate on a very different cash flow cycle from a retail outfit. So you have to be very careful in commenting about cash flows, and it's not a one-size-fits-all type of issue. And here we have just our simplification of what we were looking at earlier: overdraft balance, net cash flow, closing overdraft balance. So, that's the picture of a company that is in overdraft as its net cash balance. Interpreting cash flow statements, we've been saying all along, is a little bit limited. Yes, failure can lead to bankruptcy. That doesn't mean to say that the cash flow statement is going to help us greatly. It's important, we've said about cash flow models based on cash flow, but again, the actual cash flow doesn't mean to say that that's a good indication of future cash flows. I think most businessmen would say earnings are a better indication of future cash flows. Most of the information is already on the balance sheet, as we've been saying. Is it a good indicator of cash flows? Are earnings better? So we've just said that. Right, well, that concludes our look at cash flow statements. Sorry to come up with some rather negative statements, but I did look for research on cash flow statements. There's not a lot of commentary on cash flows. It's there, it's important, it is a statement, and but it doesn't tell us much about the operating health and future value of a company. Right, thank you.